financial decisions. Turn your radio on and listen to Give and John. It's your money and your money matters. It's your money and your money matters.
Welcome to Money Matters Minute. I'm Gib McEachran.
And I'm John Hardy.
Today we're going to be talking about investing in the Post Brexit world and what it all really means.
Well, we came into the first half of this year knowing volatility would be here, but we sure didn't expect in the last 30 days to find ourselves in a Brexit mode. Now, what's Brexit? Britain exiting the EU.
No, quite a surprise. So let's talk about what its impact has been.
Well, first of all, what it's done is created more volatility to the market because Brexit has never occurred, and it's created an unknown. And you know, if you listen to us and you invest with us, the unknown, we've always said the unknown creates volatility in the market. So we have an unknown now, and we've had volatility. We've seen the market go down,
Sure,
and we've seen the market recover.
and it's above pre-Brexit numbers. So that's been a real positive recovery that we've seen. So let's look out and say, all right, for the future, what do you think it means as far as impact to market?
Well, Brexit is going to be a period of time that's going to be anywhere from the next several months. They got to elect a new prime minister.
Right.
Cameron has to be replaced and re-elected, a new person in place. And then the Brexit, Britain has the right to unwind this over a 2-year period of time. So what is it going to look like in your investments? If it's focused solely on Brexit, you really don't know. You can subject and think that European marketplaces will probably not be the place to put money at this point.
It'll be very volatile. That volatility will spill over into our markets because there's always the chance that we're going to see a domino effect occur in Europe. First there's Great Britain. Maybe Scotland and Ireland go back for their independence and go back to being part of the EU. That's an unknown. Just those little unrests do so much to markets, and I think it really impacts where we'll be at year's end.
Now, what it's redone for the United States is put the focus back onto the United States. High quality investments that we've been talking about that's within your portfolios, things that pay dividends have been the place to be and have proven to weather the storm of Brexit, and moving forward seem to be the continued place to be.
Dividend producing investments take some volatility out of portfolios because you have the known of the dividend yield of the particular investments. So we've moved into those types of investments really earlier in January when the volatility started at the first of the year. And I think our clients are being rewarded for that, being so heavily weighted in those positions.
Now, what is going to be post-Brexit that we got to be focused on? Post-Brexit is going to have to be really currency, and the U.S. currency, and where it's going to happen in relationship to other world currencies. You know, the 10-year Treasury note this morning was at 1.367, at an all-time low in recent history. With that being said, it's because money's flocking to the United States because we have negative interest rates overseas, we have negative interest rates in Japan. We still have a place in the United States that money, you could make a deposit, and when you get your money back, you get deposit plus interest earnings. Now that is good at 1.367 because it helps what when it comes to our trade?
Well, it helps our, I mean, from a mortgage standpoint, I don't know if that's the question you're asking, but from a mortgage standpoint, it certainly helps keep mortgage rates low.
And from exporting and importing, it allows our goods and services for us to be a better place to buy and sell from an investment standpoint.
So we have to watch, when you talk about currencies, the dollar's strength, which seems to be sliding back to a more normal comparison to other currencies. But that'll be something to watch, because if our dollar continues to remain too strong, it hurts trade, because a strong dollar means some country can't buy as many widgets in the United States because they cost more.
That's right. Now, the other thing we talked about on the radio today that's important is the uncoupling of oil. And we've seen oil go up in barrel price to the $50 range. But you know what happened just in the last couple of days? It dropped to 46.67, and you know what happened to the stock market?
Went down a little bit.
It recoupled and it went down a bit. So if we can get oil to stay up the second half of this year and even go up a little higher, then we think that even increases the opportunity for a a higher market by the end of the year, higher relative to where it is now. Not big bull runs, but up still nonetheless.
We're looking for modest returns from where we are right now. So again, being in a vanilla type of portfolio, which we tend to have right now, which means a lot of dividend producing investments, is where we're going to be until the market shows us differently.
I'll mention one other thing. We had a great conversation with Bob Dahl, who manages the position of market neutral for us. And we talked through that position, and if the market will continue to do what it's done the first half of this year and provide a little upside, we do believe that's going to be a good place to be, and we'll see some modest growth in that, but safety is a good place in that position now.
So in summation, we're just going to be very safe with assets and try to eke out as much of return we can using yield as our friend.
Yield first, growth second, right?
That's exactly right.
Always remember, it is your money.
And your money matters. Thanks for joining us.